In 1999, you could have bought Nvidia stock for around $1.31 a share, split adjusted, $10,000 invested that day. If you did absolutely nothing, no panic selling in 2002, no bailing in 2008, no flinching in 2022 when the stock dropped 65% in a single year, would be worth somewhere north of $5.5 million today. That number is not the point. Most people weren't watching Nvidia in 1999. Most people are watching it now. And here is the actual question worth asking, the one that the headlines are generating enormous amounts of heat around, but very little light. Is Nvidia at $3 trillion a buying opportunity, a warning sign, or something else entirely? And what does a normal investor actually do with the answer? Because right now, almost every conversation about Nvidia falls into one of two camps. The bulls, who say the AI build-out is still in the first inning, and Nvidia is the only company that makes the chips that make any of it possible. And the skeptics, who look at the valuation and say the growth is already priced in, that the ceiling is visible from here, and that the people buying today are the ones who will be selling to someone else later. Both of those framings miss something, and in the next 17 minutes, I want to show you what they're missing, what the structural shift actually is, where the real risks live, and most importantly, what a rational, grounded financial decision looks like when the opportunity in front of you seems too large to ignore. To understand what Nvidia is now, you have to understand what it was. For most of its existence, Nvidia made GPUs, graphics processing units, primarily for gaming. High-end cards for people who wanted smoother frame rates in video games. It was a good business, a real business, but a niche one. The company's stock spent most of the 2000s trading below $10. The shift started in 2006 when Nvidia released a software platform called CUDA, Compute Unified Device Architecture. It was designed to let developers use GPUs for tasks beyond graphics, scientific computing, simulations, signal processing. Nobody fully appreciated what that meant until 2012. That year, a deep learning model called AlexNet, built by researchers at the University of Toronto, used Nvidia GPUs to win an image recognition competition by a margin so large it effectively ended the debate about whether neural networks could work at scale. The researchers didn't use Nvidia because they thought Nvidia was strategically important. They used it because CUDA was what was available, and it was fast. That accident of timing is now worth roughly $3 trillion. The right tool in the right place at the right moment. Since then, every major AI model, GPT, Gemini, Grok, the models powering image generation, drug discovery, protein folding, autonomous vehicles, has been trained predominantly on Nvidia hardware. The company's H100 chips, released in 2022, became the most coveted piece of industrial equipment in the world. Companies were paying above list price on secondary markets. There were waiting lists. Elon Musk openly complained he couldn't get enough of them. That is not a metaphor. That was the actual market. In fiscal year 2024, Nvidia's data center revenue, the segment driven almost entirely by AI demand, was $47.5 billion. The year before, it was $15 billion. Before that, $3.8 billion. This is not normal growth. This is a market re-rating what a company is worth in real time. Here is where most people get stuck, and it is worth being direct about this. The problem is not a lack of information. It is an excess of it, presented without a framework for deciding which of it matters. You can find, in the same week, a Bloomberg analysis arguing Nvidia is the most defensible technology business in history, and a Seeking Alpha piece making a credible case that the stock is pricing in 10 years of perfect execution with no room for error. Both will cite real numbers, both will use charts, and neither will tell you what to actually do. So let me give you the framework that the noise usually buries. Problem 1. Confusing the company with the stock Nvidia. The company is arguably the most strategically positioned technology business in the world right now. Its hardware dominance, its CUDA ecosystem, its early timing in the AI wave, these are real and significant. But Nvidia, the stock, is a different thing. A stock is not a company. A stock is a price. And that price reflects not just what the company is worth today, but what the market collectively believes it will be worth in the future, discounted back to today. When you buy Nvidia at a $3 trillion valuation, you are not paying for what it has done. You are paying for what it has to do next. And the gap between what the price assumes and what the business delivers is where everything gets decided. The math that matters. At a $3 trillion valuation with roughly $60 billion in annual earnings, Nvidia trades at approximately 50 times earnings. For that multiple to hold, let alone expand, earnings need to continue growing at extraordinary rates. For context, a PE of 50 on a mature company would be considered speculative. On Nvidia, it is the result of a market that believes the growth runway is still very long. They may be right, but the belief is in the price. Problem 2. Ignoring the competitive calendar. Nvidia currently controls somewhere between 70 and 90% of the market for AI training chips, depending on the metric and the source. That is an extraordinary position. It is also a position that every large technology company on Earth is actively trying to undermine. AMD has its MI300 series. Google has its TPUs, custom chips it uses internally and increasingly offers through its cloud platform. Amazon has Trainium. Microsoft has Maya. Meta has its own silicon project. Apple designs its own chips. These are not startups with pitch decks. These are the most sophisticated engineering organizations in the world, spending tens of billions of dollars to reduce their dependence on a single supplier. They may not succeed. The CUDA moat is real and deep, but the competition is not hypothetical, and it is accelerating. A business with 85% market share has one direction its share can go from here. The question is not whether it declines, it is by how much and on what timeline. Problem 3. Mistaking narrative for analysis. The AI revolution is real. The demand for compute is real. Nvidia's role in that demand is real. All of that is true. But AI is a big deal is not an investment thesis. An investment thesis requires a specific claim about price relative to value, about whether the stock you're considering is cheap, fair, or expensive relative to what the business is actually likely to deliver. The narrative around Nvidia is so compelling that it has become a substitute for that analysis. People buy the story and call it research. That is the most common and most expensive mistake in investing. All right, you understand the company? You understand the valuation debate? What are the genuine pathways for a normal investor? Not an institutional desk, not a hedge fund, to get exposure to the AI compute theme in a way that is deliberate rather than reactive. There are three. Each carries different risk profiles and requires understanding what you're actually buying. Pathway 1. Direct Nvidia exposure. The most straightforward approach is buying Nvidia directly. If you believe the AI build-out is still in early stages and Nvidia's CUDA moat holds, direct ownership gives you concentrated exposure to that thesis. The honest version of this path: you are betting that the market's current assessment of roughly 50 times earnings is not already full valued. That future earnings growth will justify or exceed today's price. This is a defensible argument. It is not a guaranteed one. Position sizing reality. Concentrated positions in individual stocks, even genuinely great companies, carry the risk of timing. Nvidia dropped 65% in 2022. Amazon dropped 90% after the dot-com peak, before eventually becoming the company it is today. Being right about a company and wrong about the entry price can take a decade to reconcile. Size your position accordingly. Pathway 2. Semiconductor sector exposure. For investors who want exposure to the AI chip theme without concentrating entirely in one company, semiconductor ETFs offer a second path. The VanEck Semiconductor ETF, ticker SMH, holds a basket of chip companies. Nvidia is its largest holding at roughly 20%, but the fund also includes TSMC, which fabricates Nvidia's chips and is a critical node in the entire supply chain. ASML, which makes the extreme ultraviolet lithography machines that nobody else on Earth can make, and that are required to produce the most advanced chips. Broadcom, which designs custom AI chips for Google and Meta, and others. This is a way to own the ecosystem rather than a single company. The drawback is that your upside is distributed. If Nvidia doubles and everything else is flat, the fund captures only a fraction of that move. The benefit is that your downside is also distributed. No single earnings miss destroys the position. Pathway 3. Broad index exposure with intentional tilts. The most underrated point in every conversation about Nvidia is this: if you own a total market index fund or an S&P 500 fund, you already own Nvidia. At current weightings, Nvidia represents approximately 6% of the S&P 500. That is not trivial. A $50,000 portfolio in an S&P 500 index fund has roughly $3,000 of Nvidia exposure already embedded in it. For investors who want more, a modest tilt, adding a semiconductor ETF or a direct Nvidia position alongside a core index holding, provides additional exposure without abandoning the diversification that makes the index approach work over decades. The framework most people skip. The question is never simply, is Nvidia good? The question is, how much Nvidia exposure is appropriate for my situation, and in what form? Answering the second question requires knowing your time horizon, your risk tolerance, and whether a significant drawdown in any single position would cause you to sell. Because the history of great companies is full of painful years before the recovery. Now, the part that matters most and gets the least airtime. Investing in the most obvious, most discussed, most universally agreed upon opportunity tends to produce mediocre returns. Not because the underlying opportunity is wrong, it often isn't, but because obvious opportunities attract so much capital that the price rises to reflect the expected future before the future actually arrives. This has a name. It is called the winner's curse. and Nvidia's current situation contains several of the conditions that historically precede it. Risk 1. Customer concentration. A significant portion of Nvidia's data center revenue comes from a small number of hyperscale cloud companies: Microsoft, Google, Amazon, Meta. These are not small customers. They are also the same companies that are most actively developing their own custom silicon to replace Nvidia hardware over time. If even one of these companies significantly reduces its Nvidia purchases in a given quarter, not cancels, just reduces the pace of growth, the earnings miss relative to expectations would be substantial. Markets do not price in modest disappointments when the stock is trading at 50 times earnings. They reprice violently. Risk 2. The CapEx cycle question. The AI infrastructure build-out is real, but infrastructure build-outs are cyclical. Every major technology wave, fiber optic cables in the late 90s, mobile infrastructure in the 2000s, cloud computing in the 2010s, has followed the same arc. Genuine demand, followed by overinvestment, followed by a period of digestion where new orders slow while existing capacity is absorbed. Nobody knows exactly when the AI CapEx cycle peaks, but there are early signals worth watching. If hyperscalers start reporting that AI investments are not yet generating the ROI they anticipated, their infrastructure spending slows. If spending slows, Nvidia's order book thins. If the order book thins, the earnings growth that justifies the valuation stops. Historical parallel. Cisco Systems was the Nvidia of the dot-com era. It made the routers and switches that powered the internet, real infrastructure for a real revolution. At its peak, it was the most valuable company in the world. The internet kept growing. Cisco's revenue never returned to its year 2000 high for over a decade. The company was right about the world. The stock was wrong about the price. Risk 3. Geopolitical exposure. Nvidia's most advanced chips are subject to U.S. export controls. The company cannot sell its H100s or the newer Blackwell architecture to Chinese customers, which represents a significant and growing portion of global AI investment. This creates two risks simultaneously. First, Nvidia loses access to a large market. Second, Chinese companies are highly motivated to develop domestic alternatives, both for economic and national security reasons, which increases the pace of competition in ways that purely commercial incentives would not. Neither of these is a company-ending risk. Nvidia has navigated export controls before, but they are real constraints on the growth ceiling, and they rarely appear with full prominence in the bull case analysis. The question is not whether Nvidia is a good company. The question is whether it is a good price for your situation. Here is what I want you to hear above everything else in this video. The excitement around a story like Nvidia's is real, and it is not irrational. The company has done something genuinely unprecedented, but excitement is not an investment plan. And the risk of letting a compelling story substitute for a plan is that you end up making a large, concentrated bet at an emotionally charged moment, which is statistically the worst time to make any financial decision. So, the same questions apply here that apply to any opportunity. If you do not have an emergency fund covering 3 to 6 months of expenses, build that first. A stock position, however compelling, cannot be your emergency fund. You cannot sell at a moment's notice without potentially selling at exactly the wrong time. If you are carrying high-interest debt, credit cards at 20+%, No investment thesis overcomes that arithmetic. Pay the debt first. If your retirement contributions are not automated, not the exciting part, but the foundational part, address that before adding single stock exposure. If those foundations are in place, then allocating a percentage of your portfolio to a conviction bet on Nvidia or the semiconductor sector is not reckless. It is intentional. The key is the word percentage, not a dollar amount that would be catastrophic to lose. A percentage, small enough that being wrong is survivable and being right is meaningful. The research on this is consistent across decades. The investors who build genuine wealth are not the ones who called every major technology wave correctly. They are the ones who stayed invested through downturns, kept their core positions in diversified funds, and let compounding do the work that no single stock pick can reliably replicate. A Nvidia position can be part of a rational portfolio. It cannot be the whole thesis. Step back from the ticker for a moment. What is actually happening, beyond the quarterly earnings and the price-to-earnings ratios, is a genuine structural shift in how computation works. For 30 years, the software industry was built on CPUs, central processing units, doing tasks sequentially. The business models of every major technology company were built on that architecture. AI changes the architecture, not metaphorically, literally. The hardware required to train and run large neural networks is fundamentally different from the hardware that powered the last generation of software. And Nvidia holds the dominant position in that new architecture, with a lead that took 15 years to build. Whether that lead translates to continued stock price appreciation at its current rate, that is genuinely uncertain. The market has been wrong in both directions about dominant technology companies, undervaluing Amazon for a decade while it quietly became the backbone of the internet, and overvaluing Cisco while correctly identifying that it would power a communications revolution. The honest answer is that nobody knows which of those analogies applies here. Anyone who tells you otherwise is selling something. The last time a company held the kind of structural position Nvidia holds today, it was a different era, a different technology, and a different set of investors making the same fundamental error, confusing the reality of the transformation with certainty about which companies would capture the value of it long-term. What separates the investors who navigated those moments well from the ones who didn't is not superior intelligence. It is not access. It is not timing. It is the patience to understand what you're buying before you buy it. The discipline to size positions in proportion to your certainty, not your excitement. And the self-awareness to know the difference between a conviction and a feeling. Nvidia may be the defining technology investment of the next decade. It may also be the most expensive lesson a generation of late-cycle buyers ever learns. The answer is not yet written. And whoever is still holding when it is, with clarity, with intention, without panic, those will be the people who look back and understand what actually happened. If this changed how you think about any of it, share it with someone who is in the middle of making this decision right now. Not to tell them what to do, just to give them a clearer frame. Subscribe if you want more of this kind of analysis. I'll see you in the next one.